You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode.
And so for today, we have Brady Weller of QSBSrollover.com. And Bradley is going to discuss with us how can investors, LPs, and founders really build wealth through this QSBS rollover program. So with that, I want to welcome Brady.
Yeah, thanks, Ernest. QSBS is definitely the most powerful tool outside of the returns from investing in or operating a startup that folks have to build wealth over the long term. So we help people do that and excited to share with you today.
Glad to have you on. Before we kind of jump in, Brady, and jump into kind of the what's going on with QSBS, wanted to learn first, how did you get to this position, and, how did this product and company come to be?
Yeah, it's a great question. We've been building financial products since mid-2019 around the real asset space. So we've built investment funds around tangible alternative assets. We've run business partnerships with high net worth individuals in that space. And through a lot of those relationships, we met a family office who started talking to us about QSBS because we had some QSBS focused opportunities on our platform that we were chatting with them about. And they brought up an interesting issue, which was, hey, we had a big exit and we didn't meet all the requirements for QSBS. What can we do about that? And we just wanted to try and add some value. And so we started digging into it a little bit more. And we ended up getting into a really fascinating rabbit hole about how people don't necessarily know how to utilize the benefits that they have available to them with qualified small business stock. And so for a lot of people, it's something that they've heard about, but it's not something that they know how to manage to build wealth when they do exit a company. And so that was sort of the journey that we started on maybe a year and a half or 2 years ago around QSBS. Prior to that, I was leading our investor relations team, started leading capital markets here as that side of our business began to grow. And now we work full time with founders, investors, LPs specifically, and venture funds who want to optimize for qualified small business stock. And that's our sole focus today.
That's awesome. And great on the customer discovery and actually kind of digging in. So with that, What is QSBS and who can benefit from it?
Yeah, QSBS is an acronym. It stands for Qualified Small Business Stock. If you go into the Internal Revenue Code, you'll find it under section 1202. So you might hear it referred to as 1202. You might hear it referred to as QSBS, but basically it is the most significant tax exemption available for folks allocating capital to sort of the startup ecosystem, small business ecosystem, or for founders of those companies. So it was designed to drive value creation in the hands of innovators and business builders. And so there are a number of different qualifications for your stock to be QSBS, but one of them is that you have to be a domestic C Corp. Another is you have to have less than $50 million of adjusted gross assets on your balance sheet. And you have to be operating in one of the quote unquote qualified business sectors. And so the code talks about excluding sectors like the medical services field, law firms, real estate, or investment businesses. And so if you think about your typical, maybe like Silicon Valley, New York, Austin, Miami startup, they could be in, technology, vertical SaaS. They could be a healthcare startup. They could be an e-commerce business, a manufacturing business. All of that qualifies if they meet the other criteria. And what it allows for is to take a large portion of your gains from selling stock in that business tax-free. That's up to $10 million per shareholder, as long as you hold that stock for 5 years. And so that's the basics of QSBS. And then there's a bunch of sort of nooks and crannies that that you can do some really cool planning around.
Yeah, when you reached out and we spoke about it, I was fascinated in the analogy because that's what I do. I love to just like think
Mm-hmm.
about different analogies. I was like, this is like 1031B for real estate, right? I think
1031
that's,
exchanges.
yeah,
Yeah.
yeah, yeah. So
That's a great analogy. It's the 1031 exchange for, not even private, for early stage company stock.
yeah,
Yeah.
yeah. And I was like, and I, in the past, have missed out on that before. And so
Sure.
it caught my attention when you mentioned QSBS. And so what strategies, you talked about the nooks and crannies, what strategies do founders and investors and advisors, what should they be doing to take advantage of this?
Yeah, it's really tough to find the actual sort of addressable market around QSBS, but we estimate that founders and investors leave somewhere between 10 and 15 billion or more on the table of gains because they don't plan around QSBS properly. So that means
Wow.
that folks are paying $10 billion plus a year in taxes that they really shouldn't have to if they had either done pre-planning or immediate planning post-exit to try and mitigate that. So it's extremely underutilized. As I said, it's hands down the most powerful tool for wealth creation for folks in the ecosystem. Some of the nooks and crannies are, well, one of them that comes up a lot is founders or investors who sort of aren't paying attention to the way that their either angel investment or deal otherwise is structured may actually be holding stock in a company that's not treated as a C Corp. So in order to qualify for this exemption, you have to be a C Corp. So sometimes what we run into is people who just have a pass-through entity, like an LLC or an S Corp, some structure like that. And that's not going to qualify you for the exemption. Most folks who are raising capital, especially in VC land, are going to have their business set up as a C Corp before they go out to raise those funds. It offers more flexibility with regard to how you structure the entity, share classes, governance, all of those kinds of things. But it also unlocks the potential for the QSBS exemption later on. So one thing to pay attention to is the stock that you own in your company, whether you're an investor or you're a founder, was that stock issued while the company was a C Corp? Because if it was issued while it was a pass-through and then you convert later without doing a share reissuance and now issuing stock out of that new C Corp or otherwise, you're not going to qualify. So it's very important that you make sure that your stock is coming from a C Corp and you're getting it directly from the company. Another pitfall that we see is, especially outside investors will buy stock in a fast-growing company via secondary, and they think that they're getting qualified small business stock as a result, and they're not, because the stock has to be issued directly from the organization. So think founders' shares, early employees who are exercising their options, or venture investors getting, equity during an equity round. So those are the things that you would want to look out for just on the very surface. The others most related to sort of when an exit starts to come around would be the holding period requirements. So you have to hold your stock, not an option to buy stock, but actually hold the stock and be an owner of it for 5 years to qualify for a federal income tax exemption. So if you're a founder, you have shares in your company, and you go and you sell it at, say, year 6, you've held your stock for more than 5 years, you can exclude up to $10 million from federal income tax. So if you make $10 million from the sale of that business in profit, you can exclude the about 24% federal income tax. So that's $2.4 million that you don't have to pay taxes, that you're not going to owe the government, including many states.
Okay.
So our friends in New York, actually, if they had a $10 million exit, many of them would be on the hook for a tax bill between $3.3 and $3.7 million. And so with QSBS, it would bring that bill to zero.
Yeah.
So making sure that you hold your stock for 5 years is incredibly important. Now, the crux of our business is solving the issue that arises if you don't hold your stock for 5 years, because no one wants to delay the sale of their business if it's rapidly growing and it's a good environment just because they're selling, at year 3, right?
Yeah,
Don't let the tax benefit wag the dog, as they say. So
Is that what they say? Okay.
they don't let the tax tail wag the dog.
Okay.
It's a weird one. I just repeat what people tell me.
That's new for
So
me. Okay, cool.
yeah, pay attention to your holding period, but we can talk about how QSBS rollovers solve that and other issues.
It's interesting because, over the last couple of years, we've had more and more individuals get interested in early stage investing. We saw a rise of SPVs and syndicates. So with that, I'm sure there's, that number of like how much is being lost is even bigger. But curious if like, okay, once it happens and then you're looking for, okay, how do we leverage QSBS? What's the time frame you have to find something to you actually leverage this?
Yeah. So if you held your stock for 5 years, you have up to $10 million of gain excluded from tax.
Yeah.
So if you made 20 million, the first 10 is tax free. The other 10 you'd have to plan for. You can do some other stuff, but the first 10 is tax free. Now, what you're describing is maybe you sell at year 3 or 4. So you didn't meet the requirements. And now you're on the hook for, in New York, that $3.5 million tax bill.
Exactly.
That's where QSBS rollovers come in. And it's the only solution for not meeting the holding requirement. And what a rollover is taking the proceeds, so the actual cash from the gain of the sale, so some portion of that, maybe $10 million that you made from the sale, and reinvesting it in new qualified small business stock. So that could be starting a new business and issuing new stock, just like you did at the start of your original company, and putting money to work in that business. Or it could be going out and searching for a business to buy, or searching for a business to invest in, like to make an angel investment. There are a couple of challenges with that. One, you have to do that in 60 days.
Okay. Wow.
So from the date of your sale, you only have 60 days. Yeah. And that's the crux of your question, but that's one of the most significant constraints. But the other constraints on actually completing a rollover would be most of the options are frankly extremely risky. If you're a founder or an investor who just made $10 million on the sale of some stock, are you really going to take that money and just for tax purposes, essentially, throw it into a bunch of startups that have a 90% fail rate, right? That's not great tax planning, especially for founder, right?
Yeah.
Especially for founders. I understand if an angel investor wants to do that, they want to keep their sort of the velocity of the capital moving and defer taxes. So that makes sense, but it's certainly a sticky situation if you're sort of rushing to find an opportunity and you can't find anything with the right sort of risk tolerance and model.
One question I have is, why am I just hearing about QSBS rollovers now? Why do you think they're not as common or popular amongst the ecosystems that I'm in?
Yeah. Well, I'll step back to add that the reason we do rollovers to begin with in this situation is because it actually allows us to continue the holding clock that we had already started with our original business. So I did mention that when describing, but for our friend who sold at year 3 and made $10 million, they need 2 or more years left in their QSBS holding clock to meet the requirement. And so by doing a rollover, it continues the holding period clock of the original stock issuance. And so you take that money, you invest it in a new business that you're creating. As long as you're in that business for, more than 2 years to meet that 5+, once you sell that business, you'll have already received sort of that initial 3 years for a combined 5. And then you can take the full exclusion on that second sale. So that's the sort of mechanics of the way that the rollover works.
Okay.
Why haven't people heard about it, or why are you just now hearing about it, is mostly owing to the fact that, as I said, there aren't a lot of good options.
Yeah.
So when you think about tax planning or planning to, retain these earnings after your exit, it's just not a good solution to throw money into a bunch of venture investments. It's risky, but it's also fairly untenable. I mean, $10 million is a lot of money. Most people might write $50 or, $100,000 checks. That's a lot of individual investments to have to make in that 60-day period to even make a dent in the tax liability. So it just doesn't make sense to do that at any kind of scale. And so something that we see people do often is say, okay, well, let me actually go and see if I can acquire a cash flowing, profitable, stable business with this money. And a really interesting thing that the tax code allows for is taking those proceeds after your sale and within 60 days, putting it in a new C Corp. So starting a new company, just like you would if you were starting a new business, and then going out and trying to find a business to acquire or a new business to start. And so we think of it maybe like a search fund type model, right? And the code actually allows for about 2 years of that market research and sort of plan development. And that can apply to the active business requirements needed for you to, be QSBS eligible. And so our friend who had 3 years on their initial QSBS, if they roll out of that into a new C Corp and start market research and search activities for a new business, just 2 years of search activities would qualify them for 5 years of total hold. If they find a business, they can go and buy it. And if they don't find it, they can actually just wind the search vehicle down and they have their full tax benefit. It might sound crazy, but what is trying to be incentivized there and allow for is, hey, you create a ton of value in the market. That's fine. Here, take a tax deferral. And then as you're looking for this new opportunity, we'll give you tax deferral and the possibility that just by sort of scouting and looking to deploy money, put money to work, you get an additional benefit. And so we actually offer QSBS rollover search as a service because you can't just roll money into a C Corp and then, go to Cabo and say that you're searching for a new business. There's a pretty high watermark for, I'm doing a legitimate market search. And so we run a full spectrum search of available businesses based on, sectors of interest for you that could be out there to buy, market analysis, business analysis, thousands of hours of research, reporting that all gets stored away for you so that when the IRS comes to you and says, hey, what have you been doing these last 2 years? I saw you acquire this business or you acquired this one, or maybe you didn't at all, but what was actually going on during those 2 years? You have a full suite of defensible materials showing that, hey, we actually ran a legitimate process here and have been searching for a business in a way that is fully QSBS compliant. And so that's something that, some of those details would just be missed by, your typical search fund operator or maybe even buy side firm. And so we specialize specifically in folks who need a rollover, are possibly interested in acquiring a new business and want to explore that. And in the meantime could benefit from that search period. We handle that process end to end.
I have to ask for our audience of emerging managers, yes, you're not allowed to roll over into a fund. It has to be a specific small business, right?
So you can roll money into, say, a VC fund.
Yeah.
But once the money's in the VC fund, it can't just be in the fund. That money actually has to be deployed into target businesses within that 60-day period. So I think that's actually a really common misconception is that, hey, I can just throw my money in this venture fund. Oh, but they didn't deploy any capital until, 9 months from now. That's not going to fly. The money actually has to be deployed into the target businesses, stock acquired, right? Because you're not typically buying stock. Stock's not being issued from a C Corp that is the VC fund. Yeah. The stock is being issued through that vehicle on behalf of the actual company on the backside. So that's an important consideration. You should know that when you're communicating with your fund manager, you have to be certain that the money that you're intending to roll over and take this tax benefit, take this QSBS rollover benefit on, that they're actually deploying the capital.
Yeah. And I probably wouldn't advise someone to invest in a fund that's deploying in 60 days all the capital.
Oh, sure. Yeah. Well, it's, a portion of the money, if you get the timing right, a portion of the money makes sense. The rollovers aren't all or nothing. So continuing our 3-year, $10 million example, you don't have to roll over all 10 million. You can pay taxes on 2 million, send your kids to school and buy a house, and then try and long-term protect the other 8 million. And so that allows for a lot of flexibility.
Okay. That makes sense. And you got into a little bit about this different services and how you all step in with the search fund as a service. What else do you guys do to step in on when these common problems happen?
Yeah, QSBS rollovers, as I said, are the only solution when shareholders sell before year 5. But they're also a solution if a shareholder held for 5 years, but they had a really outsized outcome and made more than $10 million. So very often, especially when we're talking with founders on the coast, so especially like Boston, New York, California, we see large exits, and maybe their business was started in 2018 or 2019. And so they have the 5 years, but they made $60 million. The first 10 million of that 60 is excluded from tax. And so they get a great benefit on that first 10 million, but now they have $50 million. And in New York, that could be well north of 15 million tax bill. And so actually for that second portion, that portion that exceeds the cap, there are 2 solutions that you can employ. And this will tie back into our other services, 2 solutions that you can employ. One is you can plan early and put some of that stock in a trust, maybe for your kids or your wife or someone else. And the stock that you put in that trust gets its own $10 million exclusion cap.
Okay.
So each shareholder, an individual or a trust, gets a new exclusion cap. And so that's a way you can multiply and protect many multiples above that $10 million. The other way is you can do a QSBS rollover, and you can take a portion of that excess capital of that 50 million in our example, and you can make, let's say, 3 different $10 million investments, or buy 3 different businesses at $10 million and protect 30 million under QSBS. And so it can be really powerful for large exits as well. And so in both scenarios that I described, exiting before 5 years or exiting beyond $10 million, there are two main services that we offer. One, we offer the QSBS search as a service, and that can be a great way not only to scout new opportunities in a way that is hands-off and doesn't require, 2,000 hours from you or other folks documenting all of that work. So we offer that as a service. It's a great option for folks who haven't met the 2-year requirement or the 5-year requirement, or for folks who made more than $10 million. And it can be really powerful in both situations. The other is we offer a QSBS rollover business in a box. And that happens through a partnership program with us, where functionally the partner takes gains that they have that they want to roll over, and we help them create a new C Corp and run a new qualifying business on the back of our legacy business, which is in e-commerce, actually. So we have an e-commerce brand, luxury e-commerce brand here in the US that we're able to scale a lot of capital into with our partners in a QSBS defensible, a QSBS eligible way. And so in that instance, you get a new business that is QSBS defensible with a great strategic partner while retaining almost full ownership of the assets.
Okay.
And it can be pretty hands-off. You're basically making an equity investment into a new business that you own that you don't have to manage the day-to-day of. And so that's the second product offering that we have. So rollover in a box and rollover search as a service, both extremely powerful.
That's amazing. Any kind of closing remarks that you think that folks should know about when it comes to this subject?
Yeah, oftentimes I think people believe that they are out of planning options, or it's too late, or it's too early, and they get in the sort of throes of the sale of their business or sale of stock, and they look back and they say, oh shoot, I didn't take the little bit of time to dig deep on this. Yeah. As I said at the start, this is the single biggest opportunity to, as sort of the title of our LinkedIn Live, amplify wealth or create wealth as a result of selling stock in early stage businesses. The thing that I would tell folks is, if you don't understand QSBS, or your understanding of QSBS is like, if I qualify, it's time to dig a little bit deeper and bring on a team who does this for 14 hours a day, which has been our team's life for the past almost 2 years now. No one else in the country is focusing specifically on QSBS rollovers and solving these niche problems in, again, what I said is a $15 billion plus annual market. Our core belief is that the folks in our ecosystem, angel investors, GP fund managers, GPs, founders, our engineers and designers, folks running our amazing e-com and manufacturing businesses that drive value in the US are much better capital allocators than the US government. And so, kick the IRS off your company's cap table, because they're on there in a silent way that many people aren't thinking of until that 30% tax bill comes in at the time of sale. And so, we're on the side of founders. We're founders ourselves, obviously, and happy to talk with anyone who wants to dig deep into QSBS.
Yeah, Brady, thanks for all your insights. Thanks for educating the audience and me about QSBS. It's fairly timely, as it seems like the IPO markets are finally thawing out and we're going to have more activity from an M&A perspective. So this is a very timely conversation. How should people find you?
Yep. Of course, the name's easy, QSBSrollover.com. We have a ton of articles and resources, as well as links to direct links to the Internal Revenue Code and other experts in tax law and accounting who have written extensively on these things. We have our own writing on there. We also have a really helpful tool that we just released. It's called the Rollover Calculator.
Okay.
So you can go to our site. It's right up in the search bar or in the nav bar, and you can actually type in what your gain amount was and what state you live in, and you can see how much money you might be leaving on the table. And then you can connect directly with our team who can help walk you through that. I think one thing that we really focus on, regardless of who's coming to us and asking about QSBS, is playing kind of QSBS point guard. So someone might come to us and we can't help them, or it's too early or it's too late, but they still need sort of some planning advice around future investments or endeavors. And we easily have the deepest bench of the top QSBS folks in our network. So trust and estate attorneys, tax lawyers, CPAs, investment advisors, and wealth managers. We don't take any fees for referral to any of those. We're just trying to add value for founders, and hopefully it'll come back around. So check us out on QSBSrollover.com. We're also fairly active on LinkedIn. Find us there. We'd love to connect.
Yeah, you guys have some great content that you've also made into a podcast. So you're reading some of the best articles and research that you guys have done. So thanks to all that. Thanks, Brady, for being on. Thanks to everybody who's watched this live, our first LinkedIn Live, or who'll be watching this later. Continue to follow us on LinkedIn, on Twitter, and continue to show up and listen to Swim with Allocators. Thanks, everyone.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.